Finance Minister Nirmala Sitharaman will present India's union budget tomorrow for the financial year 2023-24. And like every other year, financial markets are keenly awaiting the FM's proposals to gauge which could be the next engines of growth for India's over $3 trillion economy. This budget is especially important for investors as it will be the last full budget ahead of the general elections in 2024. Most analysts expect capital expenditure or capex to be the focal point of the budget. It may also be peppered with manufacturing SOPs, subsidies, and welfare proposals to support the rural economy. Given this, the government's borrowing plans next financial year to fund various schemes will be a crucial commentary to watch out for debt market participants. Here's what Sandeep Yadav of DSP Investment Managers has to say.
Base case scenario, yes. A capex expenditure looks good. A capex expenditure is something which probably government should do. But we're in election year, revenue expenditure should come or may come rather. So in such a scenario, what should be your market borrowing, be it fiscal or be it capex or be it revenue expenditure? But I think par for the course market is expecting something around 16 to 16.5 lakh crores of market borrowing. And frankly speaking, it's not something which is out of stretch. Last year, we had closer to 14.5 lakh crores of market expenditure. India's GDP nominal growth was around 10 to 15, was around 15%. So 16 and a half, 16 is not something, which is out of reach. What probably the market is not expecting is a market borrowing less than 16 lakh crores. If it happens, then we will certainly see a minor rally in the markets. What market is certainly not expecting is market borrowing closer to 17 lakh crores. If that happens, we'll see a minor sell-off in the market.
The Narendra Modi-led government has decided to borrow 14.21 trillion rupees from markets during the financial year 2022-23. Of this, nearly 42% was to be done in the second half of the financial year. Over the next 2 months, markets will see almost half this amount and a big chunk of the state government borrowings hitting the markets. This, coupled with potential liquidity tightening all through FY24, will decide the bond yields trajectory going forward. According to analysts at MK Wealth Management, it is likely that there could be a scramble for funds during the last few months of FY23. This is because interbank liquidity is low and banks need to offer higher rates on deposits to gather enough money. Fiscally, the free grains program and likely extension of PLI schemes to more sectors may cost more to the government and put pressure on the markets. Also, the fact that most of the borrowings are concentrated usually in the longer maturities could also bring in some pressure at the long end later in the year. Against this backdrop, how should fixed income investors play the markets? MK Wealth suggests that investment currently should be at the short end of the curve. Once the long end yields attain saturation at 7.45% or beyond on the 10-year benchmark, investments could be initiated at the long end like gilt funds. For long-term investors, MK picks credit risk funds and alternate investment funds as investment avenues. So far, in January 2023, yields on 10-year government securities have stayed range-bound, staying between 7.286% and 7.387%. Going ahead, Yadav of DSP Investment Managers expects yields to rise after the budget presentation.
I believe they will rise just after the budget. Irrespective of, where the yields are in February, I think that's a good time to buy. Why do I say that? Well, let's say yields are at 7.7% for 10 years. I think it's an amazing point to buy because suddenly you have got most of the worst news already priced in. We've got next few months where probably global growth will come down, domestic growth will come down, and probably the worst is already priced in at 7.7%. How about a converse scenario where budget is really good and we see a rally in the markets? If it's at 7.3%, I say it's still a good point to buy. Why? Well, we certainly know that supply is not going to be there for next few months, and then why not buy? Because that is the biggest risk to the market. In fact, a lower supply last fiscal year was the reason why bond yields did not go to 7.75%, because states did not come up with extra issuances. So when you add up both the things, I think irrespective of where the markets are, next year is probably the time when, and next month, in fact, February is the time when you want to buy.
On Tuesday, investors will eye the economic survey for the financial year 2022-23. Besides Q3 earnings, news flow around Adani Hindenburg case and global cues will guide the sentiment.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.